Hello everyone, welcome to this session. This session we will discuss about the KYC, what is a KYC, what are the importance of KYC and the stages of KYC. So let's start with to understand what is a KYC. So KYC basically stands for know your customer or know your client. So basically it is a series of activities and financial institution undertakes to understand who is the client, what is the background of the client, what is the nature of the transactions or what is the nature of relationship they want to have with the financial institution. Now, basically, KSC involves it's a identification and verification of customer and the customer relationships. So that is what it's a KYC. Now, why? What is exactly the KYC consist of? Now, KYC consists of collecting and verifying the identity of the customer. So basically, they collect the various documents to understand the identity of customers. The customer can be an individual, can be an organization, like or can be an entity or can be an organization, like it can be a companies like a private company or a public company, or it can be another financial institution. So basically, financial institution wants to understand who is the client, what is their background, what is the relation, what kind of relationship they want to have. So KYC consists of basically collecting and verifying those documents. By doing this, it helps them to understand the customer, what is the customer's background, and that kind of transaction they will be taking place is legitimate or not. Now, what are the essential elements? Okay, what are the essential elements or pillars of KYC? Now, usually KYC consists of there are 5 pillars or elements of KYC. The first pillar is a customer identification. So this pillar insists that the customer need to be identified. When I say identified, who is the customer will be customers identified by his name, by their professions or by the business activities they are carrying on, by their geographic location, etc. So the first pillar of KYC is customer identification process, where the banks collects various documents, and through documents they try to verify who is the client and what is the source of fund they are getting in, etc. The second stage of KYC is CAP. CAP stands for Customer Acceptance Policy. Now, every bank have to decide what type of customer or what category of customers they can accept for their relationship. Now, the bank will decide whether to accept or not to accept a client based on certain factors. So that is second The third element of KYC is a KYC is an ongoing activity. Now, the KYC, though it is usually applied, so starts with for onboarding the customer. Primarily, KYC is applied when the customer gets onboarded to the bank. It is, however, the KYC is also an ongoing activity. Means the KYC which the bank performs is valid for either 3 years or 5 years, depending on the bank. And after 3 years or 5 years, the customer have to be again recertified. So a KYC is an ongoing activity and it is not a one-time activity. The fourth element of KYC is primarily risk management. So the banks want to manage the various risks. For example, they might, if they are non-compliant with the KYC or anti-money laundering laws, they might subject to various risks like regulatory risk, legal risk, or operation risk. So to avoid and to prevent this risk, the KYC is seen as a risk management. Last is the primary element or the main element of the KYC is they want to establish the identity of the client. Now, the client, so the bank have to be ensure that the client is actually from a legal background and client is legal, and the activities what they are carrying out is also illegal. I mean, it's all legal activities. So again to summarize, the 5 elements or pillars of KYC are: 1, customer identification; second one, customer acceptance policy; third, it's an ongoing activity; fourth, KYC is done from a risk management point of view; and last is the primary motive being they want to establish the identity of the client. So these are the essential elements or pillars of KYC. Now let's look into the detail, each one by one activity, what all that kind series of activities that actually takes place in a KYC process. So first we have CIP. CIP stands for Customer Identification Process. Now, this is the first and the beginning stage in a KYC. So basically this is series of activities which is done to identify, or we can say that to know the background verification. This is basically the verification of the background verification of the client happens in a CIP stage. Now, when does the when does the customer identification is actually required? Now, primarily customer identification process is required during onboarding stage. However, apart from that, there are also certain other stages where customer identification is required. Now, as mentioned previously, the customer identification process is required when the new relationship is commenced. Let's say, for example, a investment bank like Goldman Sachs, they acquire a new client. When they acquire a new client, the customer identification have to be done. So, during the commencement of business relationship, the CIP need to be done. Point number one. And whenever the customer wants to carry out a international financial transaction, let's say, for example, a company which is based in India want to conduct transactions in the foreign currencies, like for example US dollars or a GBP or a JPY, the bank need to understand clearly what is the purpose of the customer doing this such transaction. So the CIP becomes very important in this for this. And whenever the third factor is whenever the bank have a doubt or authentication, doubt about, or they have the doubt about the authenticity, or they do not have sufficient information about sufficient or adequate information about the client, it is better the bank have to perform client identification process. Now, some of the banks provide correspondent services, or they provide the respondent banking services. Okay, for example, correspondent banking services are mainly offered by the banks whenever they want to provide foreign exchange services to the domestic clients. So, in such case, we need the financial institution have to do the client identification process for all such financial institutions which provides correspondent banking or respondent banking services to their client. So, these are some of the stages, some of the areas where the client identification process is required. Now, so we seen what are the various what are the different time or different areas where the CIP is required. Now, how does the CIP is actually done? So, first basically the document is collected from the client, and this document is actually verified. Now, the document can be many documents. For example, what are the documents actually required? One, the document is required to verify the name of the client. Now, when I say name of the client can be an individual or it can be a company. If it's an individual, now he has a first name and the second name. So, to verify the first name or a second name or with authenticity, the bank will require to collect the documents. For example, if they have to verify the name of a individual, the documents like a PAN card in India or passport is a document which is due. Second, they need to verify the complete address of the client. The address can be for an individual, can be residential or a workplace address, or for a company it can be different geographical address. They might be operating in different geographical locations. So, they need documents to authenticate and verify the address documents. Third, they need a document to verify the phone number, email IDs, date of birth or a date of registration, etc. Or the documents can be for an individual about what is the source of income. Source of income, for example, for an individual can be salary. So, you need to have employment offer letter or salary slip. So, documents are obtained. And for companies, they obtain the financial statements like a profit and loss account, balance sheet or other statements are obtained. So, these are some of the documents are actually collected, and through this documents are actually collected for identifying or for various aspects of customer like name, occupations, source of income, etc. Then once the documents are collected by the financial institution or a bank, the next process starts with the verification process. Now, verification can happen in two ways. One is a documentary verification and second one is a non-documentary verification. Non-documentary verification is verifying the document with the issuer. For example, let's say in India, the PAN card is issued by the income tax department and they also maintain a database of the PAN card holders. Now, when a customer provides the PAN card, they have to verify this information with the income tax department database to ensure that the correct the customer have provided the correct PAN numbers. Or let's say the company we are doing for a company, they need to ensure that the company is actually authenticate and it is registered. So they can go to the company registrar's website and they can ensure that the numbers which are actually the registration numbers given by the client are authenticate. So these are some of the examples of documentary verification. Now there are also a non-documentary verification is done. Now some of the examples of non-documentary verification is doing a physical visit to the address. So it can be if it's an individual, they go to residential address, or they can go to an office address, or if it's a companies, they can visit the head office or they can visit the branches, and they do a personal inspection of the address to ensure that the client or a client is operating or is actually residing in the particular area. That is one. The other way of doing non-documentary check is reference check. Reference check is normally connected through our friends or colleagues, or in case of organization through peers or business partners. So the banks call the individuals or with the references and actually checks about the they can verify the facts with these references. So these address verification, reference checks are some of the examples of a non-documentary verification. So this is how the verification are actually done. So basically we are seeing now what is the client identification process and how the client identification process happens. It happens through verification process, and the verification can be documentary or non-documentary. Now we have seen what is a customer identification program. Now let's look into customer due diligence program. So this is the second aspect. What is customer due diligence, or which is called as a CDD? So basically it is a background verification, detailed background verification of the client. Now what are the elements or what are the things a financial institution should consider before they perform customer due diligence? Now the first and foremost, as per FATF, the Prime Financial Action Task Force, those the global KYC, AML KYC regulatory. As per them, there are the four major elements need to be incorporated into customer due diligence. The first element is FATF mentions that the customer have to be identified and verified by using independent and reliable documents. Now the documents which are collected for the purpose of identification and verification have to be reliable documents, and they have to be also they're obtained from independent sources. So that's the first thing FATF recommends. Now the second important thing what need to be considered while doing a customer due diligence is the KYC analysts have to identify and ensure that who is the beneficial owner, and they need to take reasonable measures to understand. When I say reasonable measures, they need to go to the different sources to verify the authenticate of the beneficial ownership. For example, the beneficial ownership is a very important concept. Like it will show who are the actual owners of a company and who are actually receives the benefits from the company. So it is very essential to understand who is the beneficial owner of an organization. So that is the second element which need to be considered. Now the third element need to be considered is understanding what is the nature of relationship. When I say nature of relationship, it is like what is the business of the client and for what purpose they are actually open and managing this account. For example, if it's for an individual, the account will be normally for a savings account, and the source of income will be from his salary or from professions. The second, if it's a company or any other organization, it will be a current account, and basically this is operated for business purposes. For a corporate account, normally which requires FX transactions, so it requires FX transactions. So the KYC analysts have to understand what is the nature of the relationship, and as per that the due diligence have to be performed. So this is the third element. The fourth element talks about that the due diligence which is done is on an ongoing basis. It is not a one-time activity. Now the due diligence will be continued until the client maintains this relationship. So these are the four elements of due diligence. Now, added to the customer due diligence, sometimes the financial institution or a bank need to perform a enhanced customer due diligence. Now, what is this enhanced customer due diligence? Now, enhanced customer due diligence is where the bank or a financial institution do a customer due diligence. Added to that, they perform some additional steps. These additional steps for me Example could be a source of fund check or a source of wealth check. Now, what is source of fund check? Normally, when the clients are actually having relationship with the bank, in they will bring in some fund into the banking account or a trading account. Now, the financial institution have to verify what is the source of these funds and ensure that these are actually not from illegitimate or money laundering sources. Second, they have to verify the source of wealth. Okay, for example, the customer mentions in his while account opening that he has a wealth about like $5 million worth of wealth is there. They need to identify they need to identify and verify what is the source of wealth. Now, this is required primarily for a high risk clients. If the bank feels that there's a client is a high risk, then they have to perform additional due diligence. Means they, along with the due diligence, they have to perform the source of fund check and source of wealth check. Now, the enhanced due diligence will be done for the customers who the bank actually deems high risk. Now, from a customer point of view, like who are the high risk client? For example, the high risk client can be a non-resident customers, means the customer who is not residing in the particular country. Let's say if I talk about India, then the customer, if they're living in other countries, we call them as a NRIs, non-resident Indians. So, non-resident customers are the one which requires the enhanced due diligence because of their geographical nature, they are actually considered as a high risk. Now, there are another major area is sometimes there are special entities like a special purpose vehicle, normally which is created by the hedge funds or a private equity funds or alternative investment funds. Now, this special purpose vehicle have complex beneficial ownership structure. So, while the bank performing the customer due diligence, they need to ensure that they perform EDD, not just customer due diligence. Now, one of the third important thing is if it's a cash intensive business, for example, casinos or any restaurant chain, if the bank is onboarding such clients or the businesses where there is a cash intensive business, then they have to do a additional enhanced due diligence. So, these are some of the examples of customer whom the bank thinks that they are high risk and they'll be doing a enhanced due diligence for them. Other area is based on the country or geographic location. Okay, there are some certain countries or certain regions where FFTF feels that they are low jurisdiction countries, in the sense the AML KYC compliance is very low or it is not followed rigorously. Such countries are actually deemed to be high risk countries. For example, countries like Yemen, Syria, or basically some African countries. So, these countries are considered as high risk jurisdictions, and they need to ensure that they perform enhanced due diligence. Now, the geographic location not only applies for the head office, but it also applies for the branch office or other subsequent office. For example, a company might be registered in US or UK, which is basically a low risk countries. However, if these companies are operating branches in the areas or geographic locations where it feels high risk, the company have to perform enhanced due diligence. So, these are a couple of areas where if the bank or a financial institution feels that the customer is of high risk or the geographical location of the customer is deemed to be high risk, then they have to provide enhanced due diligence. So, to summarize, in this session, we have discussed what is KYC, what are the elements of KYC, and we have seen customer identification process and customer due diligence process. Thanks for your time.